The following is a presentation of TFNN.
Good afternoon, folks. Welcome. This is Steve Rhodes, your host of today's and every day's Celestial Charting webcast. Thanks for joining us. If you are listening on the archive version, or whether you're listening live, feel free always to send me an email, steve@tfnn.com. Today's webcast is going to be just a little bit different. Now, when we started the service originally, we had a number of folks that were on the Celestial Charting only subscription, and we've moved, and there's just not enough. There's so much more information on the mastering probability side, so we've got everybody converted over, if you will, to the mastering probability side. We're still going to cover Celestial Charting, but the question is, how can I be of even more service to you? How can I provide more education to you? And there's just so much with regard to the patterns and being able to teach that and being able to provide you with that information so that you can, for me, I've been doing this for so long that it's natural, but yet I can go back and remember the learning curve. And so my outcome is to make sure that we're taking a look at whatever celestial, or whether it's lunar, whether it is astro aspects that are impacting our charts, and make sure that we do that. But I want to take this to more of an educational line, if you will, and that's if it meets with everybody's approval, if you will. So hopefully that sounds good to each of you as well. Right now we have these scheduled for every other week. From an educational standpoint, I'm taking a look at my schedule to see if we can, squeeze another. Maybe we do it 3 out of 4 weeks, or maybe even 4 out of 4 weeks for the most part. We just take an hour, and it can be educational, it can be Q&A. And I'm looking for ways so that we can actually even, on a open webcast. I just didn't have a chance to get it set up today, but actually open up the mic for questions and just find a way to be able to raise our hands and not talk over each other and so forth. So we'll continue to try to improve this, to make this better for you. What I do have open right now is the keyboard, but I'll ask you not to type in any questions just yet. I want to just go through a number of the slides that we've got, but I do have the keyboard open, and hopefully we can do this in a fairly organized format. And what we'll do is try to get to as many questions that each of you have. But I do want to go ahead and and certainly cover the celestial or the lunar aspects that are out there now. This is some of my favorite pictures that were sent in by one of our subscribers, one of our clients, if you will, and I think they're great. Full moon pictures, which comes in tomorrow afternoon, and kind of cool that the market is behaving the way that it is. That it's moving down right now as we're doing this. You've got the Dow is down about 365 points. One of the things that I did about 45 minutes ago or so was sent out a newsletter that just simply had a link in it for the lunar chart that I had included in this morning's newsletter. And the reason that I did that was because I wanted you to be able to resize that on the screen. We've gone through this consolidation period for so long, and I think it's really important to help you for your individual trading decisions, as well as anything that we might do or anything that you might see. So you can blow that up on your screen. Just click on that link, and it's going to be important. We'll take a look at that, and I think it's very impactful. It's very revealing, and should help us with with some of our trades. Now, today, November the 9th, 3 p.m., we have our next one set up for 2 weeks from today, Wednesday, which I believe might be the day before Thanksgiving. I didn't get a chance to check. Right now, we'll leave that as is, but we may, if that is the day before Thanksgiving, we may try to push that up to either Monday or Tuesday of that week. We are dealing with the full moon that is coming in tomorrow, and here's the remaining schedule that we've got for the rest of the year. Again, for all the new subscribers, what we do when we're taking a look at lunar, celestial, astro aspects is we're taking a look at the American ephemeris. This happens to be just simply one page out of it. And, I recommend that you order one of these from StarCraft's publishing. It gives you a lot of the great information that we use, a lot of the information we use down here from the lunar standpoint. Moon phenomena is in here, and then there is a bottom page to this, which looks like this. And here is where you have for each day, each of the aspects that are occurring, and you can create your own little key with regard to, the fact that this is the moon and this is square and so forth. And this is very helpful for us to be able to identify major aspects that are occurring on a specific day, and as well as how many aspects are occurring, like we had the one that came in on October the 26th. These are the primary lunar phases that we look at here, and I'm just kind of flipping through this fast. This is a part of many of the other webcasts that we've done, so if you want some more detail on this, please go back and listen to the archive webcasts. They cover a lot of ground, a lot of detail. There are 5 major angles, if you will, geometric angles that we look at for the way that planets align with each other, and these are the 5. These are the angles that we use. You'll see that with regard to what we're taking a look at during this couple-week period of time. I've gone back here from October the 26th through January 2nd, so that you have this. These are the lunar phases that I've got mapped out on my charts. There's no charts just yet on the screen, Jack. These are the lunar phases in the chart that was included in this morning's newsletter, as well as the one that was just sent out, a half an hour, 45 minutes ago. And if you didn't open up that newsletter, it wouldn't be a bad idea to log in. Open up another window on your computer to log in to your members page and click on the newsletter. And what you will see is, and click on the link, and what you will do is be able to populate your screen with that. So we're looking at perigee, new moon, first quarter moons, apogee, full moon, third quarter moon, and I'll pull that chart up on a minute, but it'll be much better on your own screen with that chart. And so we're dealing here with yesterday, and when you take a look at a chart, and I just simply need to pay even more attention to it. But you had yesterday come in at apogee. Obviously, that was turned out to be a high and a turn in the market, just as many of these other. Most of the time, if we go back, which we will, in the August timeframe, you'll see that these have marked either short-term turns or turns that have occurred within a couple days, because there was a lunar phase that was occurring a couple days later. And so you've got all of these ahead of time. This is our roadmap ahead, and with regard to where we can expect to see turns in the marketplace, and it would be nice to also have retracement levels or other patterns set up for us. This is the November major astro events. That was the bottom page of the ephemeris, which is called the Aspectarian, and what we're dealing with are just, again, those 5 primary angles, if you will. And so today, November 9th, actually what we have going on out there is Neptune going direct. Tomorrow you've got Chiron going direct. I have not laid each of those aspects over the charts just to see what kind of impact they have, because the lunar phases are working so well. But these are the different aspects where there may or may not be. Sometimes they have an impact, sometimes they don't. Those of you that have been around for quite a while know that if you go back to some of the early webcasts that we've done, and those are all archived on the system, I map each of these out to see if there's any type of probability pattern that works for us. But right now the lunar phases are working very well. What I included in last night's or this morning's newsletter was I went back. I've had a number of questions from folks with regard to volume over the past week, and so I wanted to give you my take on volume. I also included what is referred to as a dollar-weighted volume chart. And so first with regard to volume and the run-up, from October of last year, really, quite frankly, the run-up from March of last year. And this is my take on that. And because there have been questions about, swing points and being able to match up volume. What we've had occur, in my opinion, in the marketplace has been a liquidity event where the Fed went out and simply, whether it was through TARP programs, whether it was through buying bonds, printing money, however they did it, what they did was they changed the game. They put more money into the environment and into the economic environment, if you will. And what happened was you just simply had a restatement of assets. Those of you that have been listening to me know that in the probably in the May, June timeframe of this year, I was going back and I did a number of studies taking a look at if gold was the currency, because it's very hard to measure the value of the dollar through the dollar index, because when you're dealing with the dollar index, you're dealing with a basket of currencies. And so I just simply used gold as the standard, and what we were able to identify was just simply that if you had bought the S&P, or you bought oil, or you bought, Apple computer with gold, when at the moment that the Fed announced that they were going to go ahead and create more liquidity in the marketplace, we were able to map out and see, was the price of the stock keeping up with what was going on. So what happened when we changed, in my opinion, when we changed that, that's why we had volume going up on lighter. We had the market going up on lighter volume as we were looking at the left side of the chart, and that was because it becomes very difficult to understand when does a liquidity event end. Well, in this case here, the liquidity event so far ended with QE2 that ended in June. Well, everybody knew that was broadcast out there, and we ran up all the way into the May 2nd time frame. So, what the chart that I included is is right here, is this dollar weighted volume chart, and this right up here, the top section of this is the actual price of the S&P. I'm sorry, this is the price of this is the actual price of the S&P, through yesterday, if you will, and the dollar weighted is really going back and taking as a base many years ago. Just start with a base to just graphically try to identify if you took a look at all of the stocks that were in the S&P, this is for the S&P 500, and simply went ahead and took a look at each stock that was up, how many shares that were traded on that specific day, and multiplied the number of shares that were traded times the price that it went up, and you took all of those, added all those up, and you subtracted any stock that went down, the value that it went down, and then you come up with a number. You would then add it to yesterday's total and continue to build on that. And in essence, what that should give us an idea of is is price moving up based on how is money flowing in. It's another way to take a look at how is money flowing in to the market, and because they really should be relatively parallel. And what you're looking for here in this instance is you're looking for some type of what's the word that I'm looking for? Looking for some type of just help me out here. What's the word I'm looking for? Where it's not lining up with each other. Well, I'm going to hope you know what I'm saying. You're looking for some type of divergence. Thank you. Okay, came up with it. I knew I could. So you're looking for some type of divergence. Well, here, because we were coming into highs yesterday, the divergence that I was able to identify, if you will, is here when you see a spike on the dollar-weighted area. So I'm going back here into the May time frame, and yet what we can see is that really price wasn't holding up here. So there was a divergence because this should have really been up. And what we can see is once we got up above this line, the market went ahead and gave it up and it retraced back down. So when's the next time when we're at highs when we see that? Well, the next time is in the September time frame, whereas on the weighted average, okay, we see this divergence where we punch through the prior high, but yet when we're taking a look at what actually went on with inside the S&P, what we can see here is that it didn't. So we had some divergence and we had a pullback. Well, we happen to have that same thing occur yesterday as I was preparing for the workshop for today and trying to help you and answer questions and identify where do I think what's going on and why. It's always nice to go back to take a look at patterns from the past to give us an idea with regard to where it is that we might go. So, I completed this probably about midnight, 12:30, decided not to send it out, wanted to see how the currencies were trading overnight. Plus, I didn't want to send this out and wake anybody up and send out because I like to send out a Twitter alert once I've sent these out so folks know that they're available. Well, so imagine that's what I produced here. Now the third time is a charm, if you will. We had some divergence yesterday, and we're seeing the response to that, quite frankly, in the marketplace. Now, with QE2 being done, my take on volume with regard to taking a look at coming into swing points on the left side of the chart as things are much more stable now, and because we're not putting more money into the game. So now as we come into swing points with lighter volume or heavier volume, I believe that correlation exists as it did and worked so well prior to the November. I think it was right around October, November of 2008. So, prior to making the lows when the Fed initially introduced the TARP program. So I believe that what you can do in your trading, and what we'll do, and we'll take a look and we'll teach you, is you can take a look at swing points and swing point volume and take a look at rejections of price as you're coming into those areas, and you can do it on all different types of time frames. And so that is one of the tools that I want to be able to teach to you over time. So we had this negative divergence here. We see the market pulling back. We also happen to have this negative divergence take place right at the time when we had a lunar aspect occur, that lunar aspect being apogee, which was yesterday. And when we take a look at this chart here, and I'll come back to this in a minute, all of a sudden we have some signals that are really lining up for us. But before I get to that, I want to just and again, this is for existing subscribers, for newer subscribers that aren't familiar with the planetary index date. This is a chart here that takes a look at 300 years worth of data, 1800 to 2100, that takes a look at each day. And sums up exactly how many planetary alignments we have going on. Those are the items that are showing up in your ephemeris, which is on this bottom section right here. And so I have totaled up each of those days and put all of that information for 300 years in this chart here. And the idea here was to identify when there would be an anomaly, if you will. And so what we had, this work here on the left-hand side, ET stands for ephemeris time. Original means it's the original work that was done by Larry Pesavento, Dr. Ruth Miller, and their work and what they used for years and years was anytime you had 3 or less planetary index dates, anytime you had 3 or less that occurred on a single day, meant that you should be looking for some type of market turn. Anytime you had 14 or more, you would have a market turn as well. What you can see here with regard to the distribution of percentages, you can see that there's more power having 14 or more, if you will, as opposed. Now, really, it's the 3 here that is throwing this off because it represents 1.82%. Still a small percentage, if you will, but this 1.82% is what throws off this high percentage here. EST is standing for Eastern Standard Time. Because I have all of this digitized, I was able to convert ephemeris time to Eastern Standard Time, and I'm still doing the work on that. I just need to find more hours in my day. And but I still have that, and that's going to be reflected even in the data here that's included with this webcast. This here, ET again stands for ephemeris time. The new ephemeris that we have actually have Chiron and a few other planets that were not in the original ephemeris where the original work was done, and that's why I have this information as well. Now, what we dealt with on October 26th for all the new subscribers was a 17 planetary index date. 35 of those will occur. This was the 20th since 1800, and there is a list of, I believe, some other dates in the last webcast that we did 2 weeks ago. That date, which now turns to be October 27th, is when the high was made. These things don't always hit on the exact day or the exact time, if you will. Now, what we have here is November 16th. These are all of the, so what I've done is taken by day, if you will. I don't know why I didn't sort it by date. That's an interesting thing. But what I have here is all of the dates. I'm guessing this looks like it starts right around November 7th, going through the end of the month. And I just simply have identified ephemeris time, new aspects, old, and so forth. And so the largest one that we have coming in here is on November the 16th. So you'll probably want to mark that in your calendar. There's 15 aspects that are occurring underneath the ephemeris time. But this is with new aspects. This is not old. And I want to just go back to that chart here real quickly for you. And you can see that what that on 15 aspects, and I've got this highlighted, that's why it's highlighted, it occurs 1.8% of the time. The reason why I want to highlight that is if under this process here, the original work that was done by Larry and Dr. Ruth. 1.8% of the time, these turned out to be turn times. I believe that we should be aware of these. So we'll be looking for, and I'll do a little bit more study work on that for November 16th, which I believe is a week from today. Is that right? 7/16. Yeah, a week from today. So we'll be taking a look at that. And here's all the other work in case anybody wants to do some additional work on their own. When we take a look at, so now I want to come to the SPY lunar phase chart. And again, hopefully you can see this okay, but you've got a copy of this that you can, again, the link where you can go and you can blow these things up. Now, what is really so interesting about this, and I'm really just coming back here from the August 6th time frame, where you can see that, this was a lunar phase. In this case here, it happened to be a first quarter. This marked, in essence, a low. Sure, the following day it went down and tested it, but closed above it. The following day it got down in there. But you can see, in my opinion, this marked an area of a low, and it moved up into the next full moon that we had, which marked a high. Still took a couple days. Market moves back down into this apogee. 2 days later, you happen to have a third quarter moon, so we can see how this and these two marked a low, so the market was moving down into it. What then happens next is you've got the market moving up into a new moon and perigee occurring 2 days apart from each other. To me, this marks an area here of resistance. That moves down into the next first quarter moon that we have. Market moves back up here. Probably, if I measured that because this is on a slide here, that's probably a 0.618 or 786 retracement area. But the market does move back down into the next full moon, moves up into apogee. So we can see, look at how these are working. So far, we've gone through all of these, and in my opinion, I haven't seen anything fail just yet. Then what happens? You've got the moon. Yes, it moves down here. Doesn't, moves down. And still comes up, if we will, right here. Why does it say camera's off? Did I lose something? Uh-oh. Are you guys able to see? No. Okay, that's interesting. Somebody did. Okay, we should be back. Must have lost some internet connection there. Let's see here. Let me try to get back. Make sure everybody is still with me out there. That was very odd. Can't see. Okay, how about that? Can you guys, is this, did you guys have this chart now back on your screen? Frederick or anyone else? Just show a notepad. You are back. You are back. Okay, great. Thank you, folks. Sorry about that. I don't have a clue what just happened there. So I believe we were right around here, around the September 7th time frame, where we can see the market moved up. It created, a short-term version of a high, moves down into this first quarter in October 4th. This is the only real failure that I've been able to really identify in the chart. We move up. It doesn't really move down, if you will. Just goes sideways. Was this really a failure? Move sideways. How would you necessarily have called this a low here? So with regard to the October 12th, October 20th time frame, realistically, I don't know how you would have called, you were at these highs. I think you would have more looked like this being a low. So I say, in this area here, we had a little bit of a failure. The market moves up. A market moves down now. Okay, the market had moved up here, moves down into this last new moon from the 26th. Obviously, the 27th, it goes up here. Market moves down, right? And look at what happened here on November the 2nd, and the market moved up into November 8th. So I hope that you find this very helpful to you for whatever it is that you might be trading. Go ahead and take these dates and lay them over anything to see what type of impact they have. And what's included here are all of the other dates for the rest of the year. So on your calendar, if you will, and I'll pull that up, these are the next dates that we have of those lunar phases that we just laid over those charts. If you ask me, I think they give us pretty good odds. So what does that mean then? What's that mean? Well, that means with tomorrow being a full moon, and if I go back to that chart, what I'd really love to see is I'd love to see the market continue to move back down tomorrow. In fact, let me just go ahead and pull up the live chart. Let's go take a look at the live chart now instead of this. Give me one moment here to switch over. And let's go and take a look at that SPY lunar chart. Okay, so we've got the lunar chart, and just to make sure I didn't lose anything, let me see. Window. Can everybody see this now? Just to make sure, because things seem to resize a bit. So can you guys see? Can you see that we've got dates at the bottom and everything? Just to make sure, just somebody can just let me know, say yes, if you will. That would be great. So now what we're looking at here, great. Thank you, Glenn. I appreciate that. So, what we can see is, number one, if I just simply draw from the last low that we had to the high, what we can see is we came down and we hit that 0.786 area. Markets moved up a little bit off of that. But, we're talking about one large move, considering we closed up at around 128. Yesterday, we're trading down at, we had traded down all the way to the 122 area. What this is suggesting to me, and you can see that we do have volume picking up. We are coming into this November 1st day. Now, that November 1st day on the SPYs had 41 million shares. Hopefully you can see that the volume is right up over in this area here. I show the date. This green area here shows the date where my cursor is at, or my crosshair, what the close, high, low, open, and the volume is. So you can see here right now where you've got 41 million shares. That's how you can follow along, and hopefully that's visible to you on your screens as well. So we're coming down to that swing point. What we would like to see, quite frankly, we would like to see it close below that high, so 123.51. So within the next 32 minutes, we'd like to see it get into there. Now, will it have the volume? Well, you got 414 million right there, and what you're doing is you've got 253 million. There's no way we're going to see the volume coming into that. With the reason why we'd like to see it get in there, because if you can close inside that swing point, even on lighter volume, it suggests that what you would do is you would at least go back and test the lower part of it. But based on what we saw on this right here, if you will, and the way that these are coming in, what we will look to do is we will look to, unless there's some other anomaly, we'll look to go ahead and take a trade on I'll figure out what ETFs or index might make sense for us to go ahead and take that trade, but we'll look at going long tomorrow. Now, depending on volume, we know we have a couple of open short trades right now, and knowing that the high that we have out here, this October 27th area, and that with regard to my thinking process, until that high is taken out, and that's such a major high, and if you are new to the subscribership, please go back and listen to the webcast, the last webcast that we did from 2 weeks ago, because there we really talked about the P index data and the importance of that, and how this is measuring very, very likely what we have put in here is a longer-term high. Now, if we get above that area, then what we'll do is we'll go ahead and reverse positions. But when you take a look, I'm actually have the S&P, the SPX cash S&P up on my screen. You can see this very long wide range bar, as we've come into this 0.786 area. What that really tells me is that what we're likely to do, and where we're coming into here, folks, is we're coming into an area of resistance. This candle right here on September 1st is a bearish engulfing pattern. And when you take a look at that, you can see I've got a line drawn across the candle, the top of the candle, that the September 1st candle engulfed, if you will. That was a resistance line while we were underneath that. The second bearish engulfing candle on the S&P 500 came in on October the 17th. Now, once we got above those areas, this became resistance. The first time down, what you can see is it came down into this area here that was on November the 1st. And that actually acted as support. The following day, it moved up. And what I want to do, I'm going to zoom out a little bit here on this screen here. So, as you know, on Monday, in Monday's newsletter or Sunday's newsletter, I showed this little channel that we're in. We're outside of this channel. The bounce that we might play out of this could be a relatively short-term trade, especially if we close much lower than this, because what I expect that we'll see, especially with this wide range bar, is that we'll come down even further than where we're at right now, where we would likely come down to Here, what I would do is just start taking a look at the retracement from that October 4th level all the way up to the top, and I would imagine we will at least get down to this point 382, the 1209 area. Maybe what else do we have there? If I just take a look at an expansion between the swing points, I would be going from this low on November 1st all the way up to the high here on November the 8th. What you can see is between the 1209, let me just try to change the color on that, if you will. Okay, so I've got an expansion. So now what I've got up here is the expansion. We're just looking at the ones that are down below here. So between 1198 and 1209, would be a logical place of maybe some resistance, if you will, and we'd be taking a look at the volume. So if the market moves back down into that tomorrow, into the full moon, when we take a look at our the way that these lunar phases have responded, we will be looking for what I would then say would be a shorter-term trade. So the question is going to be whether or not we hold on to our longer-term, since we're in it, our longer-term trade that we have in the SQQs that is still open, or whether we close that out. And I just really need some time to take a look at probability-wise what makes sense for us to do, because longer-term, and now that we've broken this channel, what you would expect to have happen is that we would move up and test somewhere near the high of this channel before we continue to move down. So that's my thinking as we speak right now. And so now what I want to do is switch over to, well, first let me ask, is there anybody that, if you've got a question now about any of the lunar or astro stuff, feel free to go ahead and type that in while you're doing that or typing something in. I'm going to switch over now to the actually, let me continue going down. Let me run through the Gartley stuff that I've got up here on the screen. H.M. Gartley, and I did this maybe a month ago or so. These are the patterns that I really want to be able to teach you, show you how I map them out, and it's really a result of work that was done back in 1935. And so I'm just running through these because you're able to replay this, and you're able to pause it, and you're able to take a look at the information that is out here. I think most pertinent of the slides, this happens to be page 222 out of his book, and in Tom's book, The Art of Timing the Trade, he talks about the Gartley 222, happens to be on page 222. Kind of wonderful stuff. This is probably the most important slide for you to take a look at and understand. And what a Gartley pattern is, bullish or bearish, is where you just simply have got a good up move, in this case here, from a bullish standpoint. And the Gartley is nothing more than an ABC pattern coming back into where the swing point originally started, in this case here. And so, and you have either a bullish Gartley or a bearish Gartley. A bearish Gartley would be, maybe something that we're looking at now, where you'd come from the October 27th high down, and then you're looking for an ABC pattern on the way up. And when you have those A to B equals C to D patterns on the way up, and you had a strong trend on the way down, they become a very good entry point to continue the move down here. Now, what typically, as you know, from a trading standpoint, if you go from the A to the D, in this case here I'm just looking at the bearish Gartley, if you had a retracement tool, what you would see if you go from A to D is that you will at least get to the 0.382 and most likely the 0.618. If you're coming into those areas with a wide range bar like we have today, with a gap down, or anything else, what you would then take a look at is you would be setting up really a new A to B equals CD down. And where we would be is this X point all of a sudden becomes your A, this would become your B, your D now becomes your C for a new A to B equals CD down. So I just wanted to throw those up here. There's a couple of charts that are probably important, of significance for you to take a look at and understand. And this first chart here goes back to 1929. And in 1929, when we had the market come down, that did not mark the low of the market. That the low of the market was in the 32-ish, 33-ish time frame. And what H.M. Gartley tells you to do is to sell the first Gartley in a bear market. And, we are in a bear market, in my opinion. And so we have been looking for this type of a pattern here to complete. And if you go back to the highs, when we were back in the 2007, 2008 time frame, this right area right in here marked the first Gartley after the move down that the market had back into the January time frame. I believe I was on the show. Tom and I were talking about just a few trades on the Money Masters show this morning, and I was getting short in this market actually further back in here. Actually up into the August 17th time frame, which is probably this candle right here, quite frankly, and then was back short in the marketplace. And remember that push down here in the early part of January. So there's reasons for us to take a look at it. This here is what's called the death cross, when you have the 50-day moving average, the blue line, crossing over the 200-day moving average. We have that going on in each of our markets right now. And this I believe this is a chart from where we were. I guess this was through yesterday or what have you. You can still see that we have this death cross in here. We don't have a Gartley pattern right now that is set up. What we do have is from the highs to the low, we had that 0.618 retracement area. We had the 17P index date come in. We have this bearish engulfing pattern that we've got up here on the New York Stock Exchange. This one right here, you can see, had acted as a resistance area. I imagine if I pull that up today, we're now quite a bit down below that. So this is a very key area here for us. So now let's go switch over to the live version of this. And I did have a few folks send in some emails. One taking a look at Bourne, another taking a look at U.S. Steel. Here we've got just happen to have the Qs up on my screen now. One of the things that I want to be able to also be able to share with you and help you understand now, this tool that I have up on my screen, hopefully it's you're able to, can somebody let me know if you can actually see or read these numbers? So for example, right here where my cursor is, it's a 1.272, which is the expansion of this swing point here. I won't, which was about 12:30 in time, all the way up on when is that? At 12:35 on November the 7th. All the way up to the high that we made into yesterday. And so, 1.272 expansion is a powerful expansion. Yes, no problem. Great. That's good. Good to know. Okay. Now, this happens to be a tool that is inside the Ensign chart package that I use. Great tool, especially if you're an active trader and you're using these sacred geometry to be able to help you understand where the market is going, where you can expect to see some possible changes. And it depends on what time frame it is that you are trading on. But what is really so very cool to see is how these numbers, actually work. Now, what you can also note from this, in this down move that we have here, as you can see that the only retracements that have been able to do have been very shallow retracements today. First retracement up is only a 0.382. Second retracement back up, only been able to make a 0.382. When what happens, the market moves down very, with good volume, if you will. And what we also have here is you can see how it stops where you've got a 1.272 area. Now, if I come up on this area here, you can see where BS is marked as 84% so far of a retracement. So it's even beyond the 0.786. Not that far beyond it. That still works pretty well. But what you can see is that we have come down on volume. You can see right now where we're trading, we have not gotten above this, and any retracement that we've had here has only been a 0.382 retracement. So when you're just taking a look at these numbers, this bodes well for us with regard to the market moving down into tomorrow, and people will be pretty fearful of trying to take a long position. Let's say the market moves down 400 or 500 points today, moves down another 300 or 400 points tomorrow. People would be scared out of their minds to go ahead and take a long position. But based on now, having truly seen, laying out those lunar phases over a chart, how would that impact your willingness to be able to go ahead and take a trade? And then especially if you use the 1% aspect, would you think that would put a probability pattern on your side? So I asked that question. I can't hear the answers, but I'm hopeful that the answers are yes out there. Now, let me go ahead and get back to, so we had a chart request that was sent in to take a look at Bourne. This was really great. Let me see here. This was a Glenn that sent in this pattern. The question was really about Bourne. So, most of you are in this trade. Some folks have not gotten in the trade. Some of the newer subscribers haven't yet had a chance to get in on this trade. And I believe that I'm somewhere, the entry point is around the 380 range. I don't recall the number right off the top of my head. And what Glenn had done was went back and he created a Gartley buy pattern and said, would it be better for him to buy in at the $3.20 area? Great, Glenn he's on the ball. He's in with us and said it was $3.48. And there's no question that would complete the pattern. And so the problem is going to be with regard to Bourne right now is this bar right here, October 4th, this high volume bar, and you can see the high on that. I hope you can see the high is 347. Now you know where I came up with my 348. Because the question is it going to get down there and just ding it and then move up? So when I take a look at that, here's the way that I would trade that, Glenn. Knowing that you've got a pattern that completes there. If you're going to risk 1%, I'd take a 0.5% at 347, and I'd take the other 0.5% at 320. And if you get both, that's a beautiful thing. And if you only get one, then you're still in a trade, and it was a good way to scale in to a trade. So what I like to do is understand these patterns, but also understand where there is some volume, and then you've got to just simply do a reward to risk, suggestion. That makes sense to you. What you also do have, if you draw the A to B equals C to D, you can see a very steep A to B, if you will, and you can see now we're starting to fall a little bit outside on the right-hand side, and so that tells us that we're losing a little bit of strength. Although with just a few days here, I'm not going to... This one's not as nice as other ones where you've got more days from a sample. So hopefully that makes sense to you. Now, what I want to do is I'm going to take this away from the chart. I want to show you what I do, how I use this to help identify Gartley buy and sell patterns. And what I'm doing here, I'm just going to delete this stuff, is what I do is really a couple of things. Number one, I take a look in this case here at the low swing point. So we're going back to that October 4th time frame, all the way up to the high that we've made here, which was on October 31st. And I just simply am taking my Fibonacci tool and going from the low to the high because we're looking at a retracement. We're looking for a reentry into this. Or in our case here, for the new subscribers, I'm looking for an entry period. For the existing subscribers, where we've taken off 1/3 of our position, looking to come back in and as a separate trade that we might come back in with another full 1%. Just depends on what I see taking place. But to stay on course here, the very first thing I do when I'm taking a look at trying to draw a Gartley or a butterfly is first just use my retracement tool, and I'm looking for a low swing point and a high swing point. So we've identified that here, and you can see where the 618 and 786 areas are. Then the next thing that I do is go really where my B point would be on an A to B equals C to D. In this case here, you can see the A point, the A, B, C, D down, if you will, would start at that 503. The B point would be, where we made our next swing point. The market moved down. It was just happened to be that next day, and so our C point we can see is up here. So what I then do is I'm looking at my expansion aspects of the Fibonacci tool that I use, and I'm going from the low of the B point to the high of the C point, and I'm now not looking at the retracement stuff that's in there. In fact, I'll get rid of that. So we can just take a look at just the expansion aspect of it. Okay, so I've got just the expansion between these two swing points, and I'm looking at the 1.272 and the 1.618. Now, from a Gartley standpoint, what I'm trying to do is I'm trying to see, do any of those expansions line up with a retracement? Well, what we can see here, and I don't know if Glenn used this process or not, but this is a great way, even if you don't have, which most people, if you're not using Ensign software, you don't have the Gartley tool that colors it in and makes it look like a nice little butterfly with wings, if you will. But what you can do, and that's why I want to be able to show you how you can do it on your own so that you can help to visualize this, is you're really just looking for sacred geometry numbers to come together in the same general area. Well, between 320 and 326, we know we have both an expansion of a swing point, that's the B to C area, and we know we have a retracement of the original move up in this. Is that helping you? Does that make sense, to you folks out there, and especially if you have these tools and you just want to use really just those 6 numbers, folks. Just use 382-618-786, and just use 1.272, 1.618, and 2.618. And if you do that, that will help you in being able to draw these patterns. Now, because I have a tool that will then allow me to really draw that, and that's how it's more visual, if you will. As you can see, I can just simply come down here, draw that, see what my pattern is, and see where, this is really a beautiful Gartley bi pattern. And the reason why I say that is because, and I'm going to get rid of the expansions, the Fibonacci stuff, just so it's a little bit clearer for each of us. The reason why I say this is so beautiful, and I really appreciate Glenn pointing that out to us, is because, look at the numbers. You've got a 786 retracement here, a 786 up at the top, a 1.272 expansion. 707 happens to be, another Fibonacci number. It's just not the one. It's not one that I want you to necessarily focus on, but when I see that pop up, this is really a beautiful Gartley cell pattern. What do I think is going on with inside Bourne itself? We haven't seen the filings of the SEC yet. That won't come out for a few days. Yes, I realize that earnings are on Friday. We'll see what happens. The way that this thing is trading intraday is every time, if you take a look at this high volume spike right here that occurred at 120. It's as if somebody has access into seeing where stops are, and they're just simply swooping them and grabbing them up. So the way that this, and it's traded like that a couple of times. I know Tom also had got his subscribers into this, and he had a tighter stop. Tom and I use different methods for coming up with stops. As you know, I especially in the volatile marketplace, I like to use the average true range. And actually, speaking of stops, I was speaking with another client yesterday, and what was logical during the conversation is that in his own trading, what he was doing, he was using the position size calculator, but was using a tighter stop, because the premise is, and I totally understand this, I get this. I've also in prior trading had the same thought process. Well, I want to use a tighter stop because these markets are so volatile. And what I expressed in my experience is that in a very volatile marketplace, what you want to do is you want to use wider stops because there's such volatility out there. In fact, you want to use that as your friend. What happens is you've got a smaller position size. You still have that 1% risk. And what's really taking place here is you are just simply, you've got fewer shares, but you're not just getting stopped out because of the volatility of what's going on. And you really want to, as you're using that position size calculator, and I hope everybody is out there doing that, and as you're getting into your own trades or using somebody else's trades, I really want you to focus in on what that average true range is, because if you make too tight of a stop and you get stopped out, that money's gone. And in this volatile marketplace, when you have a wider stop, when you have a smaller position size, what typically it means is you're not going to get a 2-to-1 or a 3-to-1 return, but you can get a 1-to-1, a 1.5-to-1. You can get those 2-to-1 returns. But if you have enough of these, folks, and you're in these volatile marketplaces, you still have a positive outcome. You still have an expectancy system that produces positive results. And so I just wanted to be able to touch on that, because the logical thing is to make tighter stops, so you don't let these things. So I really don't want you to do that. I want you to understand that in a volatile marketplace, you would use wider stops. Right now, there are many times when I take a look at trades, I have the position size calculator defaulting to 1.618, and what happens is many times I'm looking at trying to even increase that just to make sure that we're outside that range. The other request was to take a look at U.S. Steel, and this was on a monthly chart here. And what I'm going to do here is let me get rid of some of the patterns that are on here, some of the Fibonacci stuff. Let me get rid of that. Make it a little bit easier to take a look at. This happened to be a chart that I had featured in one of our newsletters. And what I was doing here on this, I was showing how U.S. Steel, how it had different hammer candles, and when the lows of those hammers were violated, much lower prices were coming. It just so happened that U.S. Steel on the weekly basis had 3 of those patterns, 3 of those situations occur. This hammer candle, worked for a bit. So we had 1 that worked, we had 2 that didn't. Here's another hammer candle. And so if you use that same I'm going to go back, and actually I'm going to even get rid of this. Okay, and so let's use that same process that I used on Bourne, which is we're going to go down to a low swing point. In the case, as you can see, of U.S. Steel here on the weekly basis, we're down into the March 09 time frame. And so what you would do is you would go from the low there, using your retracement tool, all the way up to the top, which happened to be April 9th, 2010. So that lists for us our 382, our 618, our 786 area. You can see we're trading down below that right now. Now what you would do is you would then go to, you can see that this would be our A point, the 7095 area. Our B point would be right down here on July the 2nd, 2010. And our C point would be right up here at February 18th. Again, using your expansion tool, on your that you would have on your charting software, you're looking for expansions. So let me move this forward so you only take a look at the expansions that we have. And now we have our expansions. So again, what you're looking for is you're looking for an area where you have an expansion of a swing point, your C, your B to C area, coming together with the retracement of the larger move here. So when we were taking a look at a Gartley buy pattern on U.S. Steel on the weekly chart, what we really would have been looking for, if we were trading this, we would have likely gone long right around this candle right here. And because we would have had, right about the 1.272, right at the 0.786. And on a 786 Gartley, here's the deal. When a 0.786 Gartley fails, what typically happens is it turns into a butterfly. And so with regard to taking this trade from a longer-term standpoint, you've got the volume that is down here on March the 13th. Okay. Now, what will typically happen is when you get past a 0.786 retracement, you will then do that move of a move. But because it sets up a nice Gartley pattern and you want to take a look at volume at swing points, oftentimes this will continue on and create a butterfly pattern, an expansion pattern of this. So what I would simply do is come back on the weekly chart, take a look, no, because you violated that 0.786 area, and you violated it pretty well, is I would come and take a look at the swing point here from March of 09, where you had 108 million shares, come all the way over and see what we were coming down into it with. You were coming down into it 57, 63, 67, so not enough yet to go ahead and bounce it down. You did have this little doji candle here, but I would still be hesitant. I would be looking for some better trades than this one, knowing that what we had here was we did have a Gartley buy pattern. So thank you. So it's tomorrow, I guess, that Bourne reports their numbers. So that's on U.S. Steel. But what I mostly am really trying to do here is to help you, especially for those that don't have a tool where you can draw the nice looking butterfly, to be able to draw and map these out on your own, because they're such great tools. This here, and I know you've heard me talk about this on the radio show. This happens to be the Euro USD, a US dollar trade, if you will. And again, what I'm going to do is I'm just going to get rid of some of the retracements. Again, the same thing. You would set up the same thing here with regard to trying to create your Gartley pattern. You would be going, in this case here, from the lows in June. You can see how those marked a significant low, and so you have a low here all the way up to your high. So you have your retracement area. You can see where we have our 0.618 at the 130 area. And you don't have to hit the exact number. So you're just looking to understand that range. I'm never believing that what we're going to do is buy the exact tick at the low and sell the exact tick at the high. That's just not my deal. And then what you would also then be looking for is now an expansion of the B to C swing point. In this case here on the euro, hopefully you can clearly see that this is what it'd be. I would use my expansion ruler, if you will. I'm going to just go ahead, instead of looking for other colors. I think you're getting the idea right now. And you can see that 1.618 is right in the middle of the 382 and the 618 move. So in this case here, and a 2.0 move, if you will, is right down here, and 2.618 down here. In this case here, what is, you can see that that's really not lining up. Does that mean that it's not a good Gartley buy pattern? Absolutely not. It doesn't mean that at all. You do like it when you have all of those numbers line up with each other, as when we were taking a look in the Bourne one. Now, what is happening with this Gartley pattern. So whether you got in it or not, maybe you didn't get in the trade because it didn't meet your needs to be able to get down to this 130 level. And that's cool. What you would then do when you see these patterns unfold, even if you're not in them, you're looking for the next trade to be able to get into it. Well, what I did here, and I'm going to get rid of the, there we go. I'm going to get rid of the other Fibonacci area. Well, 357. Oh, time is actually cruising by here. Let me get rid of this here real quickly. And when we see how these patterns behave, we're going from this top all the way down, so our A to our D point, if you will. And as I mentioned to you, they will typically get to the 0.618 area. And you can see that's exactly what happened. It retraced back to the 0.618 area, and now it has made, it's moved down. And where are we at today? If we go take a look at now from the low to the high, what we can see is this thing is now below the 0.618 area with a wide range bar. This tells me that the euro wants to move further, and if this 133 level doesn't hold, we'll see how that works tomorrow. Then this is suggesting some majorly lower prices coming at us. So, not enough time here really for Q&A. I apologize for that. Didn't realize, time just flies. But send me some emails. I really want to be able to help you from an education standpoint, and not just providing information about the lunar and the trading, because, I really want to be able to teach you. So, send me some emails since we don't have enough time, any suggestions that you might have, and I'll take a look at maybe even increasing the opportunity here so that we can so that I can help you really, so that you can go out there and do this work on your own. So thanks so much for joining me this afternoon, and have a great evening, and send Tom some birthday wishes if you would. Thanks, folks. Talk to you soon.